Hey, welcome to another episode of Footnotes. Today I've got a good friend of mine and someone I've known in the business community here in South Carolina for quite some time, but Charlie Banks. He is the co-founder and managing director of VentureSouth, which is an angel investing group based here in South Carolina, but operates in several different states now and has grown quite a bit since its inception. And we're here to have just a conversation about money and business and maybe some of the things that he's seeing out there in the venture world. And maybe a couple other things in between. But Charlie, thanks again for giving us your time today.
Great. Yeah, thanks, John. I'm happy to be on. Look, always good chatting with you.
At this point in sort of your career with VentureSouth, there's no telling how many pitches you've heard for early stage companies.
Yeah.
And they're all looking for capital to put into their businesses so that they can do more business and all the things that come with that. But just broadly, I mean, where do you see when you've got founders that are approaching investors? What are some of just the really common and dare I say rookie mistakes? It's rookie for a good reason, but they are those mistakes that probably come from lack of experience. What are those, especially on the financial side of things, that you guys see a lot of?
Yeah, John. I mean, we've literally seen thousands. It is in the thousands. We used to keep track of it, but we stopped after it was a couple thousand. But there are certainly some themes that all founders, experienced or not, there's some themes on which they mess up on. And our diligence, we break it down in 10 different criteria, right? And one of the things that almost every founder gets wrong, particularly the first time, is just not knowing your financials. And to dig a little deeper on that, it's really not knowing the assumptions that go into the financial models. We could say, tell us about this, this revenue, item here. Where are the assumptions and how did you arrive at those assumptions to even get to that number? And that usually trips them up.
So in other words, they put a number in for revenue, like, hey, we're going to have $1 million in revenue. But when you ask them, okay, break that down for us. Do you sell one unit for $1 million, or do you sell 10,000 units for? And I can't do the math that fast, but
Yeah.
Are you saying it's that?
Absolutely, and it even goes as far as to say, how much is this person going to be making that's on your team? And it's, well, we just kind of put in a number. And well, why did you put that number in? Because that's how much my brother-in-law wants. The assumptions of building out the financial model are really important.
Well, and so take that further, if you would. I mean, I think when people hear financial model, they think about some kind of science experiment or something that's really complex. It involves formulas and pivot tables and things like that. Is that what you're looking for, or?
No, I mean, certainly if the company is down the line and they're earning good revenue and maybe not profitable, but yet they've been in business for long enough to have good historical financials. Yeah, we'd want to see something pretty complex. But the early stage, and even if it's just right after proof of concept phase. Mm-hmm. They should have a good model built. It could just be a clean financial model, a good P&L and balance sheet, and just some projections, some 2, 3, 5 year projections that we can wrap our minds around and start figuring out, does this make sense?
You've seen thousands of these, as you said earlier, and yet it's something that I think I'm hearing you say is pretty common. I mean, why? Who's telling founders to not prepare these things?
Founders are, one of the things that almost all of them have is passion, right? And sometimes passion can cloud how they execute. We love passionate founders, particularly when they're sales oriented, right? Because the name of the game is earning revenue as quick and fast as they can. So sometimes the passion and the passion and will to execute, it kind of gets in the way of, let me slow down and build a model that investors will deem investable, right? So while it's a good thing to be passionate and really excited about building a company, but it's a double-edged sword sometimes.
So when you said building something that investors can look at, do Do you see a lot of these founders that see themselves as investors in their own company?
No, they don't feel as if they're investors. Now, sometimes some are that actually putting up real dollars to start the company. That can put their our objectives are aligned at that point because they want to see a return on their own money. But oftentimes the founders are not. They don't feel like investors. They kind of feel like the sales guy trying to get the banker to write a check. Oftentimes don't necessarily feel like it's a partnership versus a let me try to sell you on this idea.
Yeah.
And the way it is a partnership. It's a marriage. So it's the folks that go into it understanding that, listen, I've got to do this, this, and this in order for this person's money to be returned to them plus some. It tends to start the conversations out and the partnerships out on better footing.
So let's say that you've got a company coming to you that they've got revenue, they're beyond proof of concept. You mentioned earlier about you would like to see something a little more sophisticated. Do you find that that's something that they are able to build for themselves? Do they have a part-time CFO, an accountant? Like, who is helping them run those numbers and create something that is cogent for an investor, an outside investor to look at?
When it's just proof of concept, somebody has a fairly elementary version of their Excel spreadsheets, and that's okay. Everybody's got to start there. The next phase would be an advisor, or somebody that just wants to see this team or these people excel. So sometimes it's a hired advisor, sometimes it's somebody working for a little tiny slice of the pie. If a company is going through an accelerator or an incubator, there are certainly mentors that are associated with those programs that could be very, very helpful. And then you've got fractional CFOs. Those are the folks that really are trying to, it's a paid for, fee for service. So, but that's where it really starts becoming much more investor friendly, if you will, at that stage. But again, that takes a little bit of money.
Yeah.
And then the next stage would be, the company can afford to hire at least a controller, sometimes, a CFO type role. And oftentimes the founder may have a strong financial backing that can help build that out. But all that to be said, it's important to have at least one of those along that development cycle. And folks, I know like Pendleton Street, you guys have been a mentor in the space for a long time and have helped people do that. And so I think there are definitely people in every ecosystem that founders should identify as actually being helpful and not being predatory, because there are some of those as well.
Yeah, it seems like every profession, has that, especially, in people that deal with money. And I appreciate you saying that. I mean, we have helped a number of people, certainly clients, build out those models. And I will add, I think we also try to help them see themselves as investors in their own business, because if they are contributing to expertise, if they're contributing certainly their time, the emotions, all that, I mean, that has some value. And certainly a lot of them are foregoing money they could be making elsewhere by dedicating themselves fully to their company. One of the things that we see a lot of times with early and even kind of later stage, they maybe have even worked beyond angel investing, and they've got a cap table, as they say, and we'll get into that in a second. But they sort of forget that part of their compensation package for key members of their team are stock options. And they're also out there on the trail trying to raise money or equity capital, sometimes debt capital, but equity capital a lot of times also. So they're slicing off parts of their company to outside investors, and they forget about that option pool and sort of, I would say, the cap table management that we get called in to do a lot of is to kind of help some of those boo-boos that get created.
Right. Yeah, I mean, we do a lot of that. And we talk a lot about the importance of the education piece of this, not just for the investors, but the founders particularly. They really need to understand term sheets and valuations and the implications that those things have on a cap table, and the implication the cap table has on the waterfall. and the distributions and all of the things that are important for a team of people that want to get paid if they sell their company, or want to get a return on the money that they've invested in a company.
Yeah.
So, it's cleaning up cap tables is something that I'd say 70% plus of the companies that we invest in, particularly ones that are a little bit past conceptual phase and a little bit more mature, they've got cap table problems that we need to clean up. And it's not something that can't be cleaned up.
Right.
It's quite easy actually to do it. But there are a lot of ways to get tripped up and a lot of ways to get those boo-boos, as you call them.
It's kind of like it's sort of easy for a retina surgeon to operate on a retina because they've done it a lot. I think when you're not a retina surgeon and you're like, hey, go fix this person's eyeball, that's kind of hard. I mean, I think for you and I, like, we understand what those fixes are like. And I'll put in a plug I took part in this with you guys, Venture Carolina, that education piece. I mean, I would say if you are an early stage founder and you hear this, you need to check out Venture Carolina because it literally is an educational program that demystifies cap tables, for one thing. It will explain it to you in plain English. I even learned things in that module of the training that I went through with you guys. But can you maybe talk a little bit more about Venture Carolina and that education piece that you guys do?
Yeah, absolutely. So when myself and Matt Dunbar and Paul Clark, when we started VentureSouth a little over a decade ago, our thesis was that if we could educate people on how to be effective at investing in early stage companies, then we could attract more people to the asset class, unlock more capital, write bigger checks, attract better companies, have bigger returns, and therefore create this flywheel effect of capital availability across South Carolina and the region. So we founded an organization called Venture Carolina. It's a nonprofit based here in South Carolina. It's a sister organization to VentureSouth, and our objective with Venture Carolina is very simply to educate investors on how to do this, and founders on how to position the companies for funding. And we created this curriculum with our partners that dive super deep into cap tables, term sheets, valuations, due diligence, board governance, exit strategies, Angel 101. I mean, there's a lot of things that we talk about, and we throughout our curriculum. And we created this thing called the Palmetto Venture Fellowship, which John, you've been a part of. That it's modeled after the Aspen Institute that is more of like civic leadership and things like that. But what we do is we take about 24 people every year, and we put them in a room 3 different times over the course of the year, and we dig deep into all of those different elements of doing this, and the byproduct has been quite successful. We've unlocked a large amount of capital for the entrepreneurs here in South Carolina, and we're excited to continue that. It underscores the importance of really understanding how to do this and how to be effective at it.
Yeah, it's a great program. Like I said, I would encourage if you're curious about investing in that space, if you're an early stage founder, or maybe even not so early stage, I wouldn't say it's never too late for you to learn these kind of things. Because like I said, it kind of gets to a point where our clients are forced to learn those things. They're hiring a paid advisor to do that. But there's other ways to get that education, but you do have to stop and pause. And like you said, it's only 3 times a year. You do have to take a time out from your own whirlwind to do that. But again, I would say to founders that are listening to this, you are the largest investor in your business, regardless of the cap table. I know there's technically a cap table that's got everybody lined out, but when we see our clients begin to look at themselves that way, a lot changes in their business in terms of how they make decisions. They see the need for what you were talking about, Charlie, on understanding this stuff for themselves, because it does matter that much. Talk to us a little bit about what you're seeing in the sort of the venture world. You've been at this for quite some time. We've been through different economic conditions, different even the taxation on some of these things has changed. You guys have been influential in influencing state level legislation on those kind of things. Give us where are we now, if you will, in terms of venture funding, especially in the southeastern U.S.?
AI is changing the game for almost every industry.
I've heard
I don't
that.
think we've seen a pitch in the last 18 months that didn't have some element of AI built into it. So, we are encouraging founders almost daily to, obviously use the AI tools that are available to them, but yet use it in a way that is smart and is gonna be helpful and not harmful.
Do you think it's overused right now, or are we still just such at the beginning of this that you really need to make use of it in your company?
We're so early into it; it's hard to even say what overuse is, right?
Gotcha.
But it's in every industry. We've made some investments here recently that are, they're companies that their entire business model is built around, pattern recognition using AI. So it's literally in every organization that we're taking a look at. So I would just encourage folks to continue to educate themselves on what this means in the industry
Right.
that they're working in. So the macro environment is a little bit tricky right now. We've got folks that are sitting on the sidelines that are just waiting to make money so they can reinvest. Legislatively, there's been a lot of things happening in the state with the angel tax credit.
Right.
Still a lot of things that needs to be fixed on that. So we're working pretty hard on that. Federally speaking, the SSBCI program is, right smack dab in the middle of where from when we started it. So there's still a number of years left to deploy a significant amount of capital across the Southeast and here in South Carolina. So hopefully the folks that are really involved in that program are continue to invest that capital as well.
Maybe talk a little bit about investors. I know that early on, for VentureSouth, and you mentioned the investor education piece, this is, certainly an alternative asset class, and that is such a broad category of investments now. But, what have you seen change among investors, kind of where you guys are operating? You guys are in a couple of states now. So you've got a pretty good view of what of who the investors are. How have you seen that change in terms of who they are, what they're looking for, those kind of things?
If you're an accredited investor, right, meaning you've met a certain net worth threshold or an income threshold, you are eligible to invest in these types of companies, right? So that's a significant pool of people that could be making these types of investments.
Right.
But the ones that we have found that are probably the most prolific types of investors in this asset class are the ones that have built companies themselves. They've built them, they've sold them, they've had positive exits, and they understand what these founders are going through. So they can, there's a sense of sensitivity there that they're okay with. The risk profile is different than somebody that maybe had inherited their wealth or made it through real estate, or a C-suite executive that just recently retired and now they're looking to get back into the game, if you will. There's an element of luck in doing this, like anything else. I mean, that holds true even in the public markets, right? So we talk a lot about portfolio math, and it's a numbers game. You're gonna have some losers, so you need to you need to be in some the winners to pay back what you've lost in the losers.
When you talk about people who have built things before and understand the risk that early stage companies are going through, maybe they're on the other side of that, or well on the other side of that. That kind of sounds like our entire client base at Pendleton Street, and I think a number of our clients are VentureSouth investors. And of course, there's no relationship between our companies, but I can see where, and I'm glad to hear though that is a source of that funding, because I do think that the empathy, if you will, that is shared between business owners one stage or the other is fairly unique, as opposed to, like you said, kind of growing wealth or coming into wealth by other means, or maybe through other asset classes, like you said, like real estate or inheritance, or just a highly paid so and so. It sort of hits different, if you will, with a business owner. Why do you think that kinship is there?
Starting and growing companies is really hard. It's really hard. John, you and I have both been there. I mean, in doing what we're doing now. I mean, so it's that you kind of hit the nail on the head when you said empathy, right? Because there's an element of empathy there that people who have started and built companies, they share. They know what it they know what it feels like to freak out in the middle of the night of, oh my gosh, where's what do I do here? What do I do there? So. Yeah. The empathy is a big part of it, and particularly those that have done it for a long time, have done it multiple times. That their point of view is a lot different than somebody that has just sat in a C-suite, for a number of years, or like you said, from a real estate standpoint. So I can't say it better than what you said about in terms of the empathy piece. That really is a big part of it.
Yeah, I could imagine so. I mean, I think like you said, they've sort of been through it, and that it may not be always the same, but in those challenges are very similar, regardless of industry, regardless of when they were founded and things like that. I mean, there's always struggles with money, either raising money, collecting money, even pricing and things like that. I know that, I've sat through a number of presentations with VentureSouth where, to your point on the modeling, like running the numbers on pricing of a product is as much of a thing as having good financials, period. It's sort of like, hey, how did you price this? What's the rationale behind it? By the way, if a bunch of people pay you that price for the product, I mean, is that going to be okay? Are you going to be profitable? Things like that. And I've noticed that, those numbers, if you will, haven't been run that often either. Like you said, kind of go back to the passion, the excitement, the discovery that someone's really excited about. They want to wrap a company around it. But it turns out to be pretty hollow, if you will, inside that wrapper without those.
Yeah, it's a question that gets asked in every single diligence process that we run is, why does it cost that much? Or where did you arrive at that number? And sometimes they may say, well, our competitors charge about that. But sometimes it's like, well, it's just kind of what I thought it's worth, and there's, good old fashioned saying is that something's only worth what somebody's willing to pay for.
Sure.
How much, so that's a big part of it. And, folks that have been around long enough and they've been told no, on a sale, and they get feedback as to why they were told no, that's important. The failure piece of being an entrepreneur is something that should be celebrated more. We have no problem investing in founders that have failed before. I wouldn't say it's a preference, but it's a strong. I wouldn't say it's a mandate, but it's certainly you can tell a difference in founders that have failed because there's a different point of view there.
What's the difference between a lifelong loser and a redeemable failure? I mean, what are you looking for in that?
Yeah, it's very simply, what did they learn from that failure, and how are they applying it to their new journey? Mm-hmm. That seems a little cliche, but in reality, that's exactly what it is. And there's entire conferences around people talking about their failures. I don't know if it used to be called FailCon. That was the big one. But it's refreshing also when a founder is sitting around the table with us in diligence and said, at my last company that failed, we did this and this, and I'm not going to do that again. Because so they've learned from that, and those that can apply that same rationale to their passion, it's a noticeable difference. So the takeaway there is don't be scared to fail. Just as an early founder, take risks, learn from them, and don't make the same mistake twice.
That's well said. I mean, I think I kind of waffle between the celebration of failure versus, kind of highlighting winners. And I think that, whenever you overdo one of those, you're not balanced, because when you've been in the game for a while, there's almost an equal amount of both, and there's learnings on either side of that. There's probably more learnings on the failure side. People don't tend to dissect winners too much until it's like way after the fact. But I think that's a good place to maybe land this. I really appreciate your time and just being willing to share some of these nuggets. Charlie, for everybody that's listening, tell everybody where to find you, where to find VentureSouth, and even more information on Venture Carolina.
The Venture Carolina, venturecarolina.org. Would be the place to go to find out about what we're doing there. And then again, that's the educational element of what we do, particularly around the Palmetto Venture Fellowship. We have an open class right now. The next one will start this fall. So we're really excited about that. VentureSouth.vc is where to find us on the VentureSouth side. We've got a lot of information on that site. So feel free to peruse that as well. We're pretty active on social media, particularly on LinkedIn, VentureSouth, as well as me personally on LinkedIn. So happy to always connect with anybody that want to learn more what we're up to. And I'll just say, John, I love what Pendleton Street does and means to this ecosystem, and just can't thank you enough for the opportunity to talk about it, and can't thank you enough for really what you guys do in this ecosystem. It's noticeable and meaningful, and we appreciate it.
Well, thank you for saying that. It's a labor of love, and it's fun too. So that makes it a little bit easier sometimes. But thanks again for your time and just for everything that you shared.
Yeah, you bet.
We call it footnotes because often in the footnotes of a story, or the footnotes certainly even of a financial report, that's where you get more context and more kind of behind the scenes on what the report is actually telling you. And I think one of the footnotes here in this conversation with Charlie was he talked about founders of early stage companies, but I think this also applies to maybe even not so early stage companies, of having a high degree of passion for what you're doing, for your product or your service, for your customers. But that's sometimes paired with a low degree of execution. A low degree of execution in the business itself, whether that's driving revenue, whether it's continuing to innovate. But he also talked about knowing your numbers, knowing the financial underpinnings of your company, first for yourself, because we think you're the lead investor in your company, but also then for outside investors, or as you approach other capital sources to help you fund that dream. That was really interesting to hear someone who's seen literally thousands of companies ask for money to help them go further and faster. And that was the one thing that kind of came out as a footnote. Thank you again for tuning in, and we look forward to seeing you next time.